Folks, I've been getting a lot of emails the last few days about the Nasdaq, asking me, Roger, is the Nasdaq going to crash? Are interest rates, are longer-term rates going to roil the Nasdaq 100? Are tech stocks going to be bust? Should we be buying discounts? Should we be buying bargains? And so forth, and so forth, and so forth. Well, today I'm going to try to give you some answers and give you some clarity and give you a perspective of where the Nasdaq is, when would be a good time to jump in, insider view, momentum levels, the type of stocks that you should be looking at, the type of stocks you should be selling, and so forth and so forth. So today we're going to answer the question, is the Nasdaq 100 ready for action, or is it ready to be faded once again? Let's talk about it. So if you look at my screen, you'll see that the Nasdaq 100, and this is the top 100 tech stocks, you will see that it's trading between the 50-day moving average and the 200-day moving average. Now, I call this the twilight zone. And typically when we move to the twilight zone, markets or stocks that are in that sectors become very choppy. They become very, they start becoming fragmented. The sector moves away from its natural trading rhythm. And you can actually see that right now. These are the main 10 sectors in the S&P 500. And you will notice that technology and consumer discretionary, they always are next to each other. They're always, like, for example, let me go back to a random date. Let me go to 1 month ago, all right? See, consumer discretionary technology. Let me go back a year ago. Well, not a year ago. A year ago, they were pretty fragmented. But yeah, a year ago, we had the crash. But let me go back a week ago. Not a week ago, a year ago. Let me reset it back to today and go back 6 months ago. I don't know. Yeah, see, technology, consumer discretionary. The point is they're usually next to each other, very similarly to utilities and consumer staples. You have defensive sectors staying together and you have speculative sectors staying together. And whenever I see consumer discretionary and technology out of whack, they're not next to each other. That's telling me that the markets or the sector is fragmented and something unusual is going on that breaks its normal trading action. And as you could see here, we're definitely doing something that's breaking its trading action. Now, if you look over time, if you look on a two-year basis, you will find that every time the oscillator moves down to these levels, we tend to rise back up. And it looks like right now, let me close back in, it looks like we're coming higher up. If we go a little closer, it looks like we're ready to trade above the high of the last 2 days. And it looks like we're coming back up. And it looks like we bottomed out about 2 days ago, especially with the momentum levels. The RSI levels are now bottom. Now, so it looks like we're going higher. The problem with that theory is this. If you look at the number of stocks trading above the 200-day moving average, we are right now 73 stocks, 73 and a half stocks are trading above the 200-day moving average in the Nasdaq 100. But if you look at this level, we went up to 90th percentile, and we are actually on a long-term basis, and this is on a monthly basis, we're actually moving south. Now, if you look on a 6-month basis, it looks like we bottomed out and we're moving back up. But the problem with that is you still have a rubber band on a long-term basis that's extremely stretched out. And the bottom line is we can't stay near these levels. We can huff, we can puff, but the bottom line is we have to come off these levels. And these are the highest levels. Just look across here. Look across. These are the highest level in 11 years. So to me, it looks like this has to come lower, at least to the 50th or to the 30th or even to the 20th level till the market really has a chance to cool off. Now, if you look on a shorter term basis, and this is the number of stocks trading above the 50-day line, we're actually only at 30%, which means about 67% of all stocks, or 67 stocks out of 100, are trading below the 50-day moving average. So we can expect a little pullback. We can expect a little pullback on the way up. But my problem still remains the number of stocks trading above the 200-day line, and that number is just too high right now. And when you look at that, in light of the fact that we're still trading below the 50-day moving average, we could kind of pause around these levels. So in the short term, in the immediate short term, and I mean like the next 5 days to 7 days, there's a good chance we'll go higher. And there's a good chance we'll come back to the 50-day moving average. But at that point, I believe and I think that's going to be the 50-day line snapping back higher, kind of like it did when it went down here and went back up right here to the 60th level, and then it dropped back down. So I think in the real short term, in the next 5 to 7 days, I think we'll be okay as we head down to the 50-day line. Basically, I think what we're going to do is I think we're going to test the 50-day moving average. But after that, I think the long-term trend will start gaining again, and that means we're going to see lower momentum levels. I'm not going to be happy with the Nasdaq till it bottoms out to the 20th level, to the 20th percentile level, which means 80 out of 100 stocks are going to be trading below the 200-day moving average, which means this line, which means the Nasdaq needs to really cool off. And let me explain to you why I believe that. If you look over a period of about, let's go here. If you look over a period of, this is what happened previous to the correction that we had. This is the COVID correction that we had. Notice, let me just draw a little tool for you here. Let me draw this trend line for you. Notice price is moving higher here, right? And price is moving higher here. But notice the momentum levels on the RSI are declining. Notice this is getting lower. Here, let me make it, yeah. Notice the RSI is declining. Let me see if I can go a little lower time period. Let's see, 2 years. Yeah, I guess 2 years is fine. And let me show you something else. Let me draw this trend line here as well. See that? So we've been seeing this is a daily basis, but truthfully on a weekly basis, very long-term momentum shift. Price is moving higher, momentum is moving lower, then we break down, and here we have again, price moves higher, momentum goes lower, and then we break down. Now that's normal, and that's what we're seeing right now, similarly. But my concern is this divergence went on from 9/2020 all the way till 2/16. It went on for 5 months. That's a long-term break. So when you have a winding, such a big winding up pressure, the fallout can be significant. And I don't know if this is significant enough. To be quite honest with you, I don't think it is. So when we move to the shorter term basis, I'm afraid we're going to come back here, go a little higher, come to the 50-day moving average. Watch how I see this playing out. The number of stocks trading below or above the 50-day moving average moves to the 50th, 60th, maybe even 70th percentile, which would put the price action right here. And then the 200-day begins falling off. Basically, the 200-day comes up here like this little peak right here, and then we start falling off the cliff again. And that's what's causing me nervousness. And remember something, and this is something you need to pay attention to, the long-term bond. The long-term bond has a very big impact on large cap tech. And yes, I believe most of it is already priced into the market. If you look at the forward earnings on large cap tech, it's appraising at the end of this year a yield of about 3.5% on the earnings per share yield of the S&P, whereas if you look at the 10-year or the long-term bond, it's looking at an interest rate of about 2.5%, which would still put the stock market a full handle or a basis point above the interest yield on the bond market. But again, I don't know if this is going to come up very high. This pullback that we're seeing, usually you would think after a downside move like this, taking us from 9.3 yield to 1.5 yield, or from 158 on the bond to 135 on the 20-year plus bond, and after seeing oversold levels go this low, or this high, depending on which way you're looking, you would expect this pullback to take us all the way to the 50-day moving average. The fact that it's not taking us to the 50-day moving average is telling me that this bond market isn't very elastic, and this downside correction can stay around these levels, especially because usually after a big stretch out, you want to see a pullback. And in this case, we have a stretched out move, and the pullback, well, it's not really impressive. It's like one day, and then we recede back. So I'm seeing the bond market break this low, and if we break this low, it's going to put more pressure on the Nasdaq 100. And if it puts more pressure on the Nasdaq 100, there is a potential for the Nasdaq 100 to go weaker again. So I'm afraid we can rally, bring in more suckers into this market. Oh, we're seeing the Nasdaq 100 stocks rally, let's buy, and then us fall off again. Because we haven't really pulled back much, and we've gotten down quite a bit. We went from 338 all the way down to 296 in about 2 weeks. So I'm not seeing that big bounce just yet, and we may see a bounce on the QQQ, on the Nasdaq 100, similar to what we saw in the bond market, which wasn't much of a pullback. It was like a one-day bounce. I mean, look at this thing. It just goes down, 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 and it pulls back for one day, and then it reverts down again. You see that? This is the extent of the pullback. I'm afraid we'll see the same thing in the stock market. I'm afraid that what we're seeing today is this bar, and then we just peter down again. And here's what else that's making me nervous. If you look at the stocks, and again, I don't want to be a big bear. I just think we're repositioning in the Nasdaq 100, and we may need a little more downside till we're completely out of this depth. And I mean, look, let's be honest with each other. The Nasdaq 100 has given us like twice the gains of the S&P in the last year. It's maybe a little too much too fast. I mean, look at the FANG stocks. They've been just going crazy the second half of 2021. The second half of 2020, excuse me. So here's my other problem. If you look at the top gaining stocks on the Nasdaq 100, and I've been talking about this for a few weeks now. Last year, it was all tech. I mean, it was all tech. Now, you've got Fox, Expedia, Ulta Beauty. Is that a Nasdaq 100 stock? Ulta Beauty? How about Marriott? How about Trip? How about Align? That's a dental company. Dental to keep your teeth straight company. How about Priceline? How about Ross Stores? How about Starbucks? You didn't see these stocks here a year ago. And now if you look at the worst performing stocks in the Nasdaq 100, look at this, Splunk, Lulu. Lulu was like the top store 6 months ago. People were buying Lulu online, and Costco, Regeneron, Advanced Micro, Take-Two, Amazon, Zoom. So Qualcomm, CGen, all of this, DocuSign. I mean, I love the stock. So we are seeing a huge change in sentiment in the Nasdaq 100 stocks, and we're seeing a lot less tech stocks rising. I mean, Marriott, Trip.com, and we're seeing tech-heavy stocks and a lot of the favorites like Lululemon of the earlier part of, or the late part of 2020. I want to say earlier part of 2020, but late part of 2020, really, really rise. I mean, let me show you this. You got to see this with your own eyes. Look at Lulu. Yeah, look at this. The stock is breaking below the 200-day moving average. It peaked out December 17th of 2020. And if you look long-term, look at this thing. Just go up. Now it's having problem. Lululemon was a really hot stock. Nothing changed. The company's still hot, but sentiment changed. People are looking more towards going out, and Lulu's a sporting, and people tend to work out more in isolated environments. Let's look at Peloton. Let's see. I'm curious. I haven't seen Peloton on here in a while. Sports, things that people do in isolation are coming out, and things that people do with other people, going out, concerts, Disneyland, that kind of stuff, that's really, really rising. But let's look at Peloton. So yeah, Peloton touched the 200-day moving average, and it's moving up. Again, a lot of the stocks, as I said, that were hitting the 200-day moving average are now going higher. The question is, are they going to go and break above and take out the high, or are they going to fizzle out at the 50-day moving average? And I am not so positive they're going to break above the 50-day moving average, because long-term rates are going lower. Long-term rates are going higher, which means bonds are going lower, and momentum levels are still in the crapper. Excuse my French. So I think we have to be very cautious and be very careful with the Nasdaq large cap 100, the FANG stocks. I hope that helps.